Hey, what's going on, guys? Matt back with another video. In this one, I want to cover SPAC ETFs. I want to cover this because in the last 3 days, there was a second ETF that went public that revolves around SPACs. And with SPACs being all the rage as of late for this entire year, I want to go into the information that I've been looking into around SPAC ETFs to see if they are a good investment vehicle for anybody really who maybe just doesn't want to take the time to look into individual SPACs and maybe just wants to ride the wave of SPACs and have an ETF manage that portfolio and give them a decent return on their money, which is totally fair. So I've been looking into it, and here's everything that I've been finding so far. So first reference I'm going to make here is to an article on the New York Times that came out December 19th, so just under a week ago. And as you can see, the title is "The Year in Deals Can Be Summed Up in 4 Letters." This year was all about the SPAC. Now, this article goes into what SPACs are and all kinds of things around SPACs and how it's been a monumental year for SPACs in general. A lot of us already know that. The one thing I want to point out from this article is that it does cite how many SPACs were introduced this year, and that is 242 thus far, which is 4 times the number raised last year, according to SPAC Insider. The average size of a SPAC in 2020 was $335 million, which is nearly 10 times the amount in 2009. So there have been a lot of SPACs this year. And the main point I want to drive home with what that means to me is, well, I mean, in the last 3 months that I've been covering some SPACs, it's definitely under 10, and there have been 242 introduced this year. So how do we know that we're getting all the best information we can on the best SPACs out there? Well, maybe a SPAC ETF that invests in a multitude of SPACs would be a better way to invest. I'm not sure. So let's look at what the research shows. So the first SPAC ETF that came out was actually Defiance's next-gen SPAC-derived ETF. Now, the main point behind this ETF, and real quick actually, I want to point out that this came out in October. So this is October 1st, 2020 on the website ETF Strategy. The main thing I really want to point out about the Defiance ETF is these 2 quotes that I highlighted here. The fund is linked to the INDXX SPAC and Next Gen IPO Index, which allocates 80% of its weight to US listed common stock of companies that have come to market within the past 18 months by merging with a SPAC. In example, SPAC-derived companies, with the remaining 20% dedicated to virgin SPACs that are still seeking acquisition opportunities. So what does that mean? Well, 80% of the companies that this ETF is investing in are companies that have already merged with a SPAC. So it's where the SPAC has already found their private company that they're looking to take public, and they've already gone through the merger. And then 20% are just SPACs that haven't merged with anybody yet, that are still seeking candidates to merge with. The other item that I wanted to point out from this article is the index is reconstituted and rebalanced annually in December. Although newly eligible IPO companies may be added on a fast entry basis within 7 days following the company's first trading date, there are currently 36 constituents, including names such as DraftKings, Clarivate, Vertiv Holdings, Vivint Smart Home Inc., and Open Lending Corp. So I just wanted to point out that with this second quote, you are getting roughly 15% of the SPACs out there. But you need to understand that the SPACs you're getting in this ETF have already merged with private companies and are already trading. So you're not necessarily investing in that massive run-up that you can see where a SPAC hasn't announced who they're merging with yet. And then that run-up that's associated with the announcement, with a definitive agreement, letter of intent, those kind of announcements. Instead, 80% of the holdings in this ETF are on companies that have already merged. So you're banking on these companies generating revenue and doing well post SPAC. So this is a more passive investment where you're looking for these companies early on post-merger on the open market now, trading under their new ticker symbol that the private company, that better reflects a private company, I should say. And really kind of different than what most people really do when they're investing in SPACs. Because usually when you get in a SPAC, you're buying into a SPAC because either A, you want the big run-up that's associated with all those announcements that come pre-merger, or B, you really believe in the company after you find out who the letter of intent goes to, and you really see a ton of upside, and it's so early on that you actually get in more or less pre-IPO. Granted, it's not an IPO, it's a SPAC merger, but you're getting in ahead of time, whereas traditionally as retail investors, we haven't been able to do that. So that's, of course, something that draws a massive crowd that are very interested getting in on the ground floor of these private companies before they actually merge. But this ETF appears to be a little more passive and focused more on companies post-merger. So now there's this other ETF that, as you can see here, is listed on NYSE ARCA, the SPAC and New Issue ETF, and it trades under SPCX. It invests in a portfolio of SPACs that the fund's managers believe represent favorable investment opportunities. So this one's headed up by Matthew Tuttle, and you can see that this article is from December 21st, so about 4 days ago. And this one's been getting a bit of buzz, like I was mentioning at the beginning of the video, because it is an ETF for SPACs, but what differentiates it from Defiance from October is this area here, which I highlighted. Commenting on the launch, Tuttle said, as there is a limited information on publicly traded SPACs, selecting the right SPAC in which to invest can seem like a daunting task. SPCX offers investors a broad portfolio of SPACs within the familiar, liquid, and tax-efficient wrapper of an ETF. He added, the SPAC market is one of rapid change and opportunity. As a result, we feel the most appropriate strategy for managing a portfolio of SPACs is through active management, as it can be more flexible in reacting to market events. This is no place for an index fund based on a rigid set of rules. The fund has a total annual fund operating expense of 0.95%. So what do we gather from that? Well, it operates completely differently from the Defiance ETF. Basically, this one, the key word is active. What they focus on is buying into SPACs pre-letter of intent, pre-definitive agreement, pre-any announcement, really. And once there is a big run-up because of said announcement, that's when they're looking to sell off and then reinvest in some new SPACs pre-announcements. So they're looking to actively change their positions on the fly so that they can always have SPACs that are really early on, like before the merger happens. And they're evaluating, of course, their choices based on the team that the SPAC has on their board and other important factors, of course, such as their methodology in picking the private companies and so on. So this is a more active approach. This would probably align a little bit more with what current active SPAC investors are in the market for. At least in my opinion, that's what I would gather, because myself personally, I would say I'm a mix of the two. I like investing in SPACs for that run up in the beginning, but if it's a company that I truly believe in and that I'm very excited about, for example, THCB with Microvast, I'm very, very excited about Microvast. I'm very excited about Gore's merging with UWM personally because I'm in real estate investing as well on the side. So that one is one that's near and dear to me as well. So those are ones that I actually plan on holding on to long-term post-merger. However, there are other SPACs that I may not be so hot into holding post-merger and may just hold on to just for the run-up. So excuse me, I'm actually a mix of the two, and I see myself kind of being a blend, but I would probably lean more, maybe I would say 70% into this kind of active investment, and then like 30% into the passive side, the approach that Defiance takes. Now, one last thing that I want to get into is indexes. Now, we all know that an index is a collection of stocks, if you will, that measures a certain sector of the stock market. So to probably define it in a more elaborate way. I'm just going to read the definition here from Investopedia. An index is a method to track the performance of a group of assets in a standardized way. Indexes typically measure the performance of a basket of securities intended to replicate a certain area of the market. So why am I talking about indexes? Well, if you want to invest in the ETF, what you probably want to know is, how has the SPAC sector done against the rest of the stock market? Well, the only way you would find this information out, honestly, as a kind of holistic, broad view of all SPACs, is by looking at an index of SPACs. So, for example, you have the S&P 500, right? The S&P 500 is an index that looks at the 500 companies that make it up, right? Now, there's certain criteria to be part of the S&P 500. As we all know, Tesla just got in because it met this criteria. However, there are other indexes as well that are relatively new that are now tracking SPACs to see how they do. So here I have another article from Bloomberg, and this one is actually titled "New SPAC Index Beckons ETFs While a Now Dead Gauge Warns of Pain." The main thing I really wanted to look into on this article is how it talks about the IPOC SPAC Index. Now, the IPOC SPAC Index is one index that, as you can see here, is on the IPOC's website. It talks about their index that measures a certain amount of SPACs pre-merger, and if I'm not mistaken, it holds on to a lot of these SPACs post-merger. So reading this section here, the IPOC SPAC Index may hold on to shares of the resulting business combinations from SPAC reverse mergers for a period of time, but the SPAC is intended to capture performance from IPO to deal consummation. Gavrish's index, in contrast, aim to invest in companies after they emerge from the SPACs. Gavrish's index is another index that they talk about early in the article, where back in 2017, I believe the company was Edelon, if I'm not mistaken. Edelon Capital. Edelon Capital back in 2017 actually had their own index. It failed after a few months only because there wasn't that much buzz or that much interest in SPACs at the time. But back then, that index was aiming to invest in companies after they merged from the SPAC, so it was kind of a post-merger index, whereas this IPOC SPAC more closely aligns with the Matthew Tuttle SPCX ETF, where it's a more active view of SPACs, where it captures their performance from IPO of the SPAC to the merger with the private company, and then more or less would drop it from the index at that point. But it's saying it can hold on to them for a period of time after that. There's another index out there called INDXX SPAC and Next Gen IPO Index. So this one has actually been shown to beat out the INDXX 500, which is another index tracked by INDXX, and it is their version more or less of the S&P 500, not quite the same criteria, but a lot of the large companies in the US. And they are actually showing that their SPAC index is actually beating out their top 500 company index. So this is something where I was able to find some concrete evidence of how SPACs are doing right now. Now, granted, their 500 index, I wouldn't say is apples to apples with the S&P 500, but I'm just using that for comparison's sake right now. But if you want to look into exactly what methodology that the INDXX uses to make its 500 index, you can actually see here I have their methodology pamphlet where they go into all of that and how they created that index. But for the most part, I just wanted to be able to cite something here that shows how SPACs are doing over the last half year, as this one's been only tracking for the last half year thus far for the SPACs that are in their SPAC index. And IPOX, has actually also been trending well. It looks like it's been just over a 10% gain in the last 5 months on here. So let me know what you guys think. Let me know if you are actually going to be investing in any ETFs. Right now you have the Defiance one and you have the SPCX ETF. Defiance being the more passive one, and the I'm having trouble saying that, and the SPCX one being more active. I personally probably won't be investing in these ETFs. If I do, it's more so out of curiosity. But personally, because I do spend a lot of time looking into these individual SPACs and the ones that I want to invest in, I'm not really kind of passive, not paying attention to it, because I paid attention to all this so much. I prefer kind of picking and choosing my own. But let me know what you guys think. Let me know if you're looking into investing in these. Let me know if maybe you're kind of taking my same approach, or what you think overall about these ETFs. Hopefully this information was valuable to you guys, just to give you a little more insight into a different way to invest in SPACs. But that's it for today, guys. I'll see you guys on the next one.